Welcome back. We're talking about the 7 rules to retirement security. Now, in my 19 years of experience, having started as a wealth manager over 19 years ago here in New York City, it's been my experience that if you follow these 7 rules, it's going to give you the highest probability of having a successful and secure retirement. We talked about rule number 1. Rule number 1 is the most important. It's number 1 for a reason. That's to avoid large losses. Then we talked about rule number 2, the importance of transitioning from stage 1 to stage 2 with your assets. Now we're going to talk about rule number 3. Rule number 3 involves significantly reducing your volatility. And I want to talk about this concept of a safe withdrawal rate. For those of you who don't know, this idea of a safe withdrawal rate, that's supposed to tell you how much you can safely pull out of your portfolio on an annual basis without running out. And we can see here, historically, the safe withdrawal rates have moved around quite a bit. If you retired in the 1980s, you were told that the safe withdrawal rate was 6%. So if you had $1 million and you retired in the 1980s, you thought to yourself and were told that you could safely pull out $60,000 of income every year. Then in the 1990s, it dropped to 5%. Now you can only pull out $50,000. Then in the 2000s, it dropped to 4%, $40,000. Today, the safe withdrawal rate is about 3% or $30,000. And in the future, we don't know what's going to happen. Why does the safe withdrawal rate move around so much? It's because it's based off market conditions. Think about it. If you went down to the bank in the 1980s, you probably could have got a CD for 10% or more. But now, even with rates having moved up slightly over the last couple of years, we're still in a historically very low interest rate environment. Well, what is the importance of the safe withdrawal rate and managing volatility? Because we're talking about rule number 3, you must significantly reduce your volatility in retirement. Let's go through an example here. Let's assume you have $1 million in portfolio and you go down to Vanguard, the Merrill, the Ameriprise, and they tell you you can safely pull out about $50,000 per year in income. Now let's assume you've got a financial advisor, they're charging about 1%, and you've got additional fees, expense ratios, and trading costs adding up into what we call Wall Street fees. Well, what would have happened if you retired into a bear market? Let's say you retired into 2000. In 2000, the market was down 10.14%. Now you started with $1 million, you suffered a loss of $101,000, you paid yourself $50,000, you paid your advisor $10,000, you paid another $20,000 in product fees, you're down to $818,000. Then again in 2001, the market's down again 13%. Again, you're starting with $818,000, you suffer a loss, you pay yourself, you pay your advisor, you pay Wall Street, you're down to $637,000 by the end of year 2. Then in 2002, the market drops again 23%. You're starting with $637,000. By the time you factor in the loss, you pay yourself, you pay your advisor, you pay Wall Street, you're now down to $419,000. Now from 2003 to 2007, the market crushes it. Excellent, great returns. What's the problem? Well, you're earning those high rates of return in a much lower capital base, a smaller amount of money. And then in 2008, we go through another bear market. And in this example, by 2012, 12 years after you started your retirement, you are out of money. Now, if you're out of money, how much income are you getting from your assets? Not a trick question, 0 income coming in. There's a very specific term for this type of risk, and it applies only to retirees and people who are going to use their money for income. And this is called sequence of returns risk. That's why it's so important that rule number 3 is that you must significantly reduce your volatility in retirement. That's why part of the foundation of what we do here at South Point is what I call stage 2 planning. It all starts with risk mitigation, income generation. Get the risk down, get the volatility down. That in turn will allow us to produce more consistent and predictable income.